Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, David Shapiro, Sasfin Securities, Drikus Combrinck from Capicraft. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gents, thanks for the time. Drikus, let's start with you. And this is a direct question I got on the Twitters earlier. Why are markets at highs when everything looks dodge? Drikus, this is risk on. How are you reading this? Because there's a lot to worry about, but markets aren't.
Yeah, there's also saying that markets climb a wall of worry, right? So a lot of the unknowns are known, a lot of the risks are known, and I know we had a big shock in April, and the Trump administration has backtracked from that. So it's a lot of people still returning to the market. There's a lot of liquidity going around.
Yeah.
So there's the expectation of more liquidity coming in the form of lower Fed funds rates going forward. And most central banks around the globe are cutting interest rates at the moment, while they are supporting liquidity by other means as well. So a lot of liquidity going around. Liquidity comes and goes. There's a caveat. It looked like the big indices were starting to roll over just a week ago, but the market yesterday and the day before just said, it looks like we're going to get our Fed funds rates lower and more liquidity will be coming down the line. And we continue the rally that we've seen since April. I'm not convinced. I'm treading lightly.
Staying close to the door. David, there is lots of liquidity. The inflation data yesterday seemed to have gladdened the market's hearts. And, as someone who's a long-only investor, I'm not complaining about all-time highs. It does just feel a little weird, but I suppose we take it.
Of course you take it. I was listening to Paul Krugman the other day, and he said, markets are not a good indicator of the underlying economy or something to that effect. And people don't buy if they don't feel confident. And no one's going to go and put this kind of money into the market if they feel threatened or under pressure. So I always respect people who go out and buy. Even if you look at our market today without preempting any questions that might come in, nice person process strong. Why? Because of Tencent. Good results coming out of Tencent. So, there's a change there. And so we go. The gold price is up, Harmony's up, and so on. So I think don't ignore what the market tells you. And the fact that we are at these highs, I respect that. And again, I say that no one's going to go spend this kind of money or use up the liquidity if they don't feel that the outlook is fairly bright.
I agree 100%. And you mentioned Tencent. Their Tencent music results out today, very strong. Question coming through, is Naspers process still worth it? Is this still the easiest way to get China? David, it is a nice, easy way to get China. And then Tencent has numbers and they go up 4%.
I haven't gone through them in great detail. I think they only came out, I know we're recording this, so it only came out about an hour ago and I haven't had a chance. But the outlook has been bright and people still believe that Tencent, Alibaba are worth going for. There are two areas of the Chinese market that still look very attractive. And if they're going up, believe me, regardless of whether we have those people on the delivery bikes or not, that's going to dictate where nice person process goes. So, purely on the back of Tencent, nice person process still well positioned.
Drikus, what's your take on China? We haven't been on air for a while. Is China a sector, a space, a geography that you look at for investing in? Do you stay away? Do you have preferred?
Oh, we've got a small position in China. We prefer the mainland shares, much cheaper at this stage. I think the Hong Kong shares and the dual listeds have run a bit far for now. The easy money has been made there. But you could say it's a multi-year story. China has to pivot to its local economy. It has to pent up local demand. There isn't a property story anymore. That's the Chinese property sector is in a bit of a depression the last few years. And secondly, you can only export so much. They've got a surplus of about $100 billion a month. That is just think how staggeringly large that is. And you can only export so much. You cannot outgrow the world economy with your exports. So they have to pivot locally. They have to encourage consumer spending. They're already encouraging investors to get back into the local equity market. And I do think that is a structural change and must be positive for the local market going forward. Obviously, the risk there is that, the trade spat widens and that, you get some sort of sanction on dual-listed Chinese shares, something similar maybe to what happened with Russia. That might happen down the line. So keep that in mind. Don't bet the barn on it, but I think you cannot be without Chinese exposure at this stage.
Yeah, okay. No, I did take a point. And it's that shift. They 20 years ago, they were building everything. Now they're trying to get everyone to spend everything. Drikus Capitec question came through. I've been wanting to buy it for ages. It just always goes, looks expensive. Do I just close my eyes and buy it? Drikus, your take on Capitec. Trading update today. Not a bad trading update. Some T's and C's in the numbers, but it is, it's a wild stock.
Yeah, I'm in the same boat. So I'm the wrong guy to ask that question. It's been running away for me for the past 10 years as well. Every now and then when it looks cheaper, I think, here it is now. Some of the bad debts are coming home to roost now. And then when I blink, it's up 20% again. Then I've missed my chance to get in. Look, I'm a bit of a cheapskate, a value investor, if you will. I prefer apps at a 6 PE. So I'll leave Capitec for those that are more astute business analysts than myself.
Or perhaps braver. David, are you astute or brave? What's your take on Capitec?
It's one of the few stocks on the JSE that I have great admiration for. And they're reading the market properly. They really are a top business here. And, what are they up, even though their T's and C's, it's 22% or whatever it is. It's a big number. There's no bank that can catch them. You might question those numbers. You might be cynical, but the customers love them. And I think they're going on a whole campaign to tell you how much their customers love them, simply because their offerings are simple. But you can't ignore this. And, at the moment, the trend is your friend. And it's not showing any signs of strain. Because when the strain comes, then you can say, okay, I've had enough. You can just press the button and get out. But for the meantime, I still think they're a very solid business.
Yeah, thank you. Question coming through on Richmond. David, Swiss tariffs might not have as big an impact, and maybe Trump will reduce them, and much of their earnings is jewelry nowadays. Is there opportunity here as the stock's been under pressure? David, for you, Richmond?
You know what? They're starting to look attractive. I think if we go into an environment of lower interest rates, ability or the trying to get the world economy on its feet again, I think eventually they will pick up. If you're going to buy a Rolex, and this is not a Richemont watch or any of those fancy ones, I think it gives you snobbish value if you can afford it with the tariffs as well. So I think it's going to. I think they'll beat that offside trap. At that level of spending and that level of richness, I think some of these businesses are not going to feel the pinch of those ridiculous 39% tariffs on Switzerland. So, into weakness, I'm beginning to look at some of the luxury stocks again.
Drikus, it started the year with a bang with the trading update in January. It was up at, 3,800. It's now down at 2,800. Is Richmond something that would be on your list?
Yeah, I'm not sure tariffs really should affect it all that much. A lot of these watches are bought on, while traveling in big travel spots like Hong Kong, Singapore, etc. So I'm not sure that tariffs should affect them, too much. Secondly, it's Chinese spending would obviously help. They like their watches. The long-term story about Chinese gifting, corporate gifting, that thesis has gone out the window, and that's partly why we've seen a bit of Richmond sales, let's call it, difficulties in China. But I do think Chinese consumer spending will pick up. That should bode well for Richmond. It's not not that cheap yet, but certainly one that you should keep on your radar. Yeah.
So, Drikus, let's stay with you.
You know, Simon.
Yeah.
So there's just one thing I always have to wonder. You know, I mean, the skills that go into making those watches has been passed on from generation to generation. There's no ways they can onshore it into America and get the watchmakers there. You know, I mean, sometimes I just totally perplexed by Mr. Trump's views and attitudes and that. You know, there's some things that you just can't bring to America, and it's those kind of skills, and particularly in the luxury market. You know, so I still like them. I still think that, and Drikus makes a very important point. So many of those watches are bought traveling. You know, where you actually find they're sometimes free of duty. Yeah. So it's a good business. Withstood many downturns.
Oh yeah, no, and just keeps on coming back. Drikus, Afrimat, and the question is, it just, you know, the whole market's risk on, and then it doesn't love Afrimat. Stock down 2% today, trading in the low 40s. I get that the last set of numbers were ugly, but there's Lafarge again, a lot of moving parts. Drikus, thoughts on you around Afrimat?
No, a large part of the problems that they've had recently is lower coal prices. Remember that they've also got coal mines. Iron ore hasn't been all that great, but iron ore prices are picking up, and now they've brought in the cement. The difficult industries, I think they are excellent on execution, but the market did put them on quite a premium, and now they're in difficult markets, and maybe, you know, the premium that they have needs to disappear for a while, until they can show they can execute on the cement business. I'm watching from the sidelines for now. I was a shareholder for very long, but there's a lot of new businesses here, and I think, you know, the coal business will add a lot of production in the next few years. That should help. But I'm on the sidelines for now, Simon.
David, Afrimat for you?
Always loved. You know, from the time they listed in the construction boom, but lately I think their price has gone all the way back to where they were 4 or 5 years ago, which is unusual for a company that was a favorite. But you know, they branched out of aggregates. In other words, the what do you call it, the sands and cement and everything that goes into
quarries.
Yeah, and you know, now anthracite, iron ore mining cause a lot of problems, and those prices come down, so does the mine. So if you look at the chart, it's awful. I don't know if you can show it on the you know, on the screen there, but I mean, it's just heading one way, and that's down, and so far we haven't seen any kind of support. So just on that basis, you know, there's the issues, and of course it's in the earnings as well. So for a company that I would imagine is still very well run, I think you know, the areas in which they've entered now are just causing lots of problems. Yeah. Just avoid it, and for the meantime, I think you can go to, you know, you'll find better.
So, David, staying with you, question coming through. Are we late for the Dr. Copper party? And should I look at the Copper ETN or maybe one of the miners? Not sure who's who. David, Copper for you?
I don't know. That's such a tough question. You know, it's holding up, and in fact, it's one of the few commodities, if you look over time, has actually done okay and is holding there. But it's not reaching those levels that everybody says it should be. But we said maybe the same with platinum, and suddenly it broke away. But it's okay. I'm not one who likes to buy single commodities. You know, it's if you want to go into lithium, or you want to go into copper, or you want to go into any one of these on a single basis, you've got to be a trader with a lot more knowledge than certainly me. Maybe Drikus has got more knowledge of single commodities, but I would never risk any kind of exposure on that basis. So it's holding, it's doing well. People are very positive about the outlook for it, particularly with the purchase, with the expansion of electricity or power into data centers. But I'd rather go into the data centers rather than copper.
Drikus, for you, some copper, or also staying away from single commodities?
No, I like certain single commodities, but you know, the setup must be clear to me. So we like uranium. We've done very well in uranium. I think there's and the bull market in uranium is most certainly not over. I like silver. I liked gold. Not that bullish at these levels though anymore. Longer term, you'll be fine there. And copper is interesting, one. From a supply side, and I do like to look at things from a supply side. That's better, much easier to gauge than demand. As from a supply side, we're not finding any more big tier one resource of copper. Unless it's deep within the jungles of a DRC, and where we've got a lot of political risk and etc. So I do think if there's going to be a growth in demand of copper, it certainly looks like it, then we're going to have a problem sourcing the stuff, and the price needs to go much higher to justify going deep into the DRC for that.
Yeah, it is, absolutely. Well, else we're remining the old goldfield mines in Northern Cape from the 90s, which used to be the copper mines. Drikus, to stay with you for a moment, question coming through. Grard, I've long had my eye on the stock and was worried about the violence last year. That seems to have abated, and the price has come down. Is the stock offering value at under 12 Rand? Drikus, Grard, for you? I know you've liked it at points, but things change. What's your current take on it?
We like the spin-offs coming from it. We made a lot of money with Grard shipping, one of the lesser understood businesses in SA. Grard, we also walked away last year somewhere. The violence that perked up in Mozambique, but things look like it died down there. If Transnet can move more trucks down to Richards Bay, it sounds like it. Then there's a lot more coal moving through the Richards Bay coal terminal, which belongs to Grard. And Grard is expanding into other logistic businesses adjacent, to their current businesses as well. It's not the same business that it was 5 years ago. It's a much more stable business. Having gotten rid of a lot of businesses that weren't really contributing to growth, or that made it very cyclical. I think it's a much better quality company, and I think it looks cheaper. We re-entered a small position recently, and it looks cheaper.
David, some Grard for you?
I can't say more than what Drikus said. I think it's well positioned in logistics. I think the downside is always if there are issues with commodity prices, with shipping and so on.
Sure.
But for the meantime, I think they seem to have overcome it. It's a decent business. Look, it's a business that should be very well placed in South Africa. For exports, particularly at this time. Yeah, I can't say no. It's not one that I'm in, but I think, I'd go with it if one wanted to take a chance on it, surely.
Question coming through, David, talking around offshore or global drug companies. Are there any standouts that are worth adding to a portfolio? I don't have any healthcare, and I think drugs are looking like the right space. David, for you, is it an Eli Lilly or Novo Nordisk or even craftier than that?
I think the time is coming to look at pharmaceuticals. They've gone through a very difficult time. And that's really brought about by regulation, by government, by the middleman. The drugs that are being produced at the moment are superb. A lot of breakthroughs in all kinds of areas. And then you've got the doctors who want to use them. But in the middle, you've got politics. And that's killing the market. But I think with interest rates coming down, this is a sector that has underperformed. It could start to look attractive. Eli Lilly and Novo Nordisk, if you take away the emotion, of everybody responding to each trial that comes out, because you might miss by a decimal point. If you take away all of that and you look at the absolute numbers, they're superb. I think even Eli Lilly's revenues were up, in 38, 40%. I can't remember. Profits also in a similar area. So these companies are doing well. It's the emotion that's just killing them at the moment and worries about, government and drug prices and so on. But I think with rates coming down or likely to come down, one could start to look at the healthcare sector again.
Drikus, is it one that you're interested in? I always worry about as David mentions, the regulatory environment. But is there a drug company that stands out for you, or is it a sector you're avoiding for now?
I think I'm on record on this show about 2 years ago. Someone saying I'm staying away from the sector because of the regulation, coming their way, and all the other political scrutiny coming their way. I don't think it's over yet. But, it's some of it is already priced in, if not most. Sanofi Aventis, which is outside the US and would be subject to much less, scrutiny than what the Trump administration will be putting on their players, sitting on an 11 price earnings ratio, 5% dividend yield. To Europe's biggest drug manufacturer. That's not a bad valuation.
Yeah, no, I get your point on that. Question coming through around Nvidia. Does the new ChatGPT add more value to Nvidia? Drikus, here's an eye-watering stock. I mean, I don't know what the price earnings are, what, 30, 40, that's forward. But I mean, it does and it's doubled since the Liberation Day tariffs. Drikus, your thoughts on Nvidia?
Yeah, listen, so there's a lot of revenue already booked into that income statement. Forward revenue booked in there. So at one stage, the quarterly earnings will disappoint, and the stock will drop. Maybe it's next quarter, maybe it's in 5 years. I don't know. I'm not good at playing musical chairs, so I'm not there at the moment. This is a cyclical business. Do not forget that. And the chip wars are starting to heat up. There's other adjacent industries. If you want to play the whole I think there's lower risk, cheaper ways, to enter the whole AI theme at the moment than going for the biggest company on the planet.
What would be one of your alternatives for an AI trade?
Well, we're moving away from the chip makers. Well, there's a chip maker in Singapore at the moment that we're doing due diligence on, so I'm not really going to call out the name yet. It's trading at a 7-8 PE ratio, so a lot cheaper to be sure. But we're playing it at the data center level. There's a company called Landbridge that we've written on. Landbridge is in the Delaware Basin. They own a few thousand acres of land there. It's a royalty company, so they already make money from what they're doing, but they're trying to source data centers in, and West Texas is the ideal place to build data centers. So there's one of two ways to play the West Texas, data center rollout theme, if that were to realize. And both of them aren't discounting that at the moment. The other one is Texas Pacific Land, and the one that we're doing is through Landbridge.
Yeah, we've chatted about these before in the show. They own vast trusses of land, and as you say, they basically rent it out for royalties. David, we need to go to stock picks. We understand you love Nvidia, but your stock pick today, Home Depot.
No, it's not going to be Nvidia. I think if you're in, stay in. If you're not in, I think what Drikus said makes a lot of sense. But they're still ahead in terms of where they are in terms of technology. But competition will come in. I'm going for a string of rate cuts in the US. They're going to happen. And an area that has lagged has been on the home building side, on the housing side. And I think Home Depot, still a superb business, long, strong history, well managed, good balance sheet. I think it's time to start looking at companies like that. So I like Home Depot. I still have it in portfolios, but I think I wouldn't be, I'm not afraid to start increasing or look at it as well. But I think we're going to go into that kind of area now, which is going to throw open a whole lot of new opportunities.
Yeah, and potentially if we start seeing some rate cuts, that could help as well. Drikus, you came at one that I've never heard of before. I'm going to mispronounce it, but I'm going to try it. Lindell Basil.
Oh, Little Basil, that's from, with my Afrikaans accent. But it's not a small company. I think it's the second biggest, basically chemical company in Texas. They've got a JV previously with Sasfin, so that's the name Little Basil should ring a bell. And just look at the share price; it's dropped to below the recent April lows. It's sitting just above the 2020 COVID lows.
Yeah.
It's a chemical company, not too much dissimilar from what Sasfin is doing in Louisiana, with their chemical business, and it's plastics at the end of the day. And no, the chemical market isn't a downturn; it's a cyclical business. You try to buy these when the P's are high. Now the P is high after the latest set of quarterly statements, and I do not suspect the next 2 or 3 quarterly statements to be great either. But they are one of the lowest cost producers. They're in the top quartile of low cost producers. They will sit this one out. They've got a very strong balance sheet, and it's trading at an 11% dividend yield at this moment. Even if they do cut a dividend yield, which they can hold on to, you'll still sit with a 5%, 6% dividend yield. So if you're willing to ride the downturn in chemicals out, this is the way to do it. This is like buying Sasfin at 50 Rand.
Yeah, okay, and actually I saw that dividend yield and I thought maybe there was an error, but you confirmed dividend yield of 11%. That's all for Stockwatch today. Thanks to our guest David Shapiro, Sasfin Securities, Drikus Combrinck from Capicraft. Up next, the close. Stay watching.